I'm Andrew Stotts from Maybank Kim Eng, and today I want to talk to you about my latest report, which is called Riding the Liquidity Wave. Obviously, we've seen the markets rise a lot, and the question I'm trying to address is, do we keep exposure in the equity market or do we start reducing it? Before we get into that, I really want to highlight the stocks that we had in our original portfolio. And those stocks, we can see that 4 of them actually have done quite well, with one of them, Jasmine, up about 45%. We're making changes to this portfolio, and so what I'd like to do is introduce those changes now. We're taking out, actually, I'm taking out 3 stocks out of the portfolio right now, and those 3 stocks are Advance, BEC, and ESSO. Advance and BEC are consumer stocks that have been pushed up very high in valuation. And so I'm starting to get a bit nervous on the valuation, and therefore I'm taking them out of the portfolio. And in the case of ESSO, I was basically playing a theme of the concept of the company being taken over. Now that we've risen quite a bit on ESSO, I'm ready to get out. I'm replacing these with 3 stocks. One is SCB, Siam Commercial Bank. The second one is Thaicom. And basically the third one is Thai Oil, the refiner. Now, in the case of Thai Oil, it's really valuation, and I like the valuation of the company and the story of the company. In the case of SCB, I'm trying to increase my exposure to the finance sector and the bank sector. And then with Thaicom, it's a turnaround. And in this case, it's a turnaround that I believe has real legs to it. So you can see the portfolio. We've got 9 stocks plus cash. We have 10% allocated to each of these components. What I'd like to do is just talk a little bit about the market and why I'm not too worried about the market right now. The first thing is what you can see on this chart, and the bar that you can see on this chart all the way to the right shows that there's been a massive amount of inflows of foreign funds into the Thai stock market. Now those inflows have pushed up the market, and of course we're seeing those inflows across Asia. Why is that? Well, money's coming back out of developed markets into the developing markets, and so I feel comfortable continuing to ride this wave. Now, continuing to ride this wave really depends upon whether the market is cheap or expensive. The chart I'm showing right now, you can see the PE over time in Thailand with a 1 and 2 standard deviation band. What you can see from that is that the Thai PE right now at about 15 times is not yet expensive. Yes, it's moving up and it's no longer cheap, but I'm willing to ride this liquidity wave because the market is not yet expensive. As it breaks through to 17, 18, 19 times, I'll get a little bit more concerned. Well, why is that? Well, because I've just done a study going back over basically from 1975 to today. I've looked at many months, every month in between that time, and I've looked at whether those months the market PE was low or high. I grouped the market PE into deciles, and each of those deciles I rank on the left side of this chart, and you can see, for instance, 3 to 6 means the market was trading at 3 to 6 times, and we can see that 6% of all the months since 1975 the market is traded at that level. At the opposite end of this, you can see the market trading at 27 to 30 times. Only 1% of all time months from the period since 1975 is the market traded so expensive. But what's remarkable is you can see that below 18 times, if you buy the overall market, you're going to get a positive return both in the short run, 1 year, and in the long run, 3 year. But in the case of as the market starts to get more expensive, you could still make money on a 1-year basis on occasion, but on a 3-year basis, no. So 18 times is kind of my rule of thumb number that I don't want to get too aggressive in the market over 18 times. With the market at about 15 or 16 times right now, I'm comfortable to ride that wave. The last thing I want to talk to you about is the research I've done, a lot of research on the banking sector. And the chart that I'm showing you right now basically shows the CapEx cycle for banks themselves. That means ATMs, branches, and software systems. This CapEx cycle has just peaked. What have they been spending their money on? Building a consumer bank. To build out a consumer bank requires a lot of investment, and that investment now is done. The marginal cost of bringing on new consumer loans is very low. And that means that the consumer banking business, which is a new business for Thai banks, is now moving into cash cow phase. So I'm increasing my weight in the bank sector, mainly because we've got very expensive consumer stocks, banks are not as expensive, and because I think that we've got a great future for the Thai banks. That's it from me this week. I hope to see you next time from Maybank Kim Eng in Thailand. Thank you.